many investors, particularly wholesalers, house flippers, those house buyers, they oftentimes look at seller financing as being a last resort. And they're really missing a ton of money when they view that. Exiting via seller financing needs to be part of your normal exit strategy. It shouldn't be like a last resort. It should be part of your overall policy of how you're trying to exit homes.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today's guest, Jay Redding, has over 20 years of experience, including over 100 flips, a rental portfolio, tax liens, private lending, self-directed IRAs, and mortgage note investing. He now focuses on teaching investors how to structure installment sales that pay, create sellable notes, and allow them to recapitalize without going back to the grind. You can find him at CassidyInvestments.com. Jay, thanks for taking the time today.
Thank you, Dylan. I appreciate the opportunity. Been looking forward to this discussion. This should be good.
You know, and I mentioned to you before hopping on here, I want to get into notes, and I've had a number of different people in the note space on the show talk about, what notes are able to do. But I want to talk today about how to create a note, and then also, logistically and on a granular level, the steps that people need to take. And I'd like to start off really with, what is the segment that best applies for notes? Is it distressed sellers? Is it folks that have listed a home for high days on market? Where can you find a good opportunity to create a note?
Okay, here's what I would tell you. All right, many house buyers out there, they don't have a problem getting into the deal. Okay, there's people that talk all over about it. Okay, exiting via seller financing needs to be part of your normal exit strategy. It shouldn't be like a last resort. Okay, it should be part of your overall policy of how you're trying to exit homes. All right, because what happens so often is that, all right, many investors, particularly I'm saying wholesalers, house flippers, those house buyers, I'll just group them all together as far as house buyers. They oftentimes look at seller financing as being a last resort, and they're really missing a ton of money when they view that. So the markets that we find that are the best for seller financing is your working class neighborhoods. Okay. Now, depending upon what part of the country that you're in, that's a different dollar. All right. I'm based out of the Midwest. I'm based out of Indiana. All right. Most of the stuff, when we're talking working class, we're talking 180 to 150,000. That's a working class home neighborhood. That is perfect. The thing that you have to remember when you're doing seller financing or private financing like this for long term, you're essentially filling the gap that the banks are leaving behind. So wherever the banks aren't, that's where it fits for what we're doing. So you're looking for individuals. The buyers are essentially going to be individuals that they come up short okay, for the bank financing. They make good income, they have good down payments, but they don't check all the box for Fannie and Freddie to be able to sell that loan on Wall Street.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
We come out, we have more flexibility to create terms. All right. Yes, the terms are going to be higher. The interest rates is going to be higher because they are a higher risk, but you have to document that they've got the income to handle it. All right. They have large down payments. All right. And as a result, you could put together a note that will perform exceedingly well. We've worked very heavily in working with house buyers who work in the Latino community, quite honestly. And part of that is because they're hardworking individuals. They're honest individuals. The culture is used to going one-on-one type of individual type of investing. Okay. And many of them don't trust banks. Okay. For whatever reasons. Okay. It's just part of the culture. And we have found our greatest success in working with those house buyers that have realtors that are deeply tied into the Latino community. They tend to bring large down payments. When I say large down payments, I'm talking at least 10% or greater. Okay. We see 10, 15, as high as 25%, not uncommon in this type of environment. All right. And the interest rates typically are 10 to 12%. All right. That is as far as the note face interest rate. And they typically pay them off early. That's what they basically do. So these individuals are contractors, your gig workers. All right. They're 1099 type of workers, but they work hard. They make a good income. And we have found that model has worked exceedingly well.
What kind of rates can you put onto these notes where you're at, and is it tied to what the rates for mortgages are, or because these are outside of the traditional banking system, is it, hey, we're providing you this service, but you really can't be looking and comparing it with the rates that are available through your bank?
Great question. Number one, you need to be aware of what your state's usury laws are. That's the first thing. Every state's a little bit different. All right. Pennsylvania is one that's a little odd in that respect. But as long as you know what the usury laws are, you're certainly not going to go beyond that. But since where we're at right now, we're looking at 6.5%, 7% as far as a bank loan. Okay. 5 to 6 points. All right. Above that is not uncommon. Typically, if you're looking to sell this note down the road, it's going to be somewhere in the 10 to 12% range. That's what you're looking at in that 100 to 150,000 price range. Now, if you're looking at 250, 300,000, if that's your working class neighborhood for where you're located, then that's going to be a little lower. That's going to be probably in the 9 to 11. If you're looking like on the coast, East and West Coast, then you're probably looking at 9 to 10. Okay. Just because of that's larger dollars that are involved in there. So that would be my guidance.
Now, when we talk about the process of creating these notes, and I do want to dive into the weeds here.
Sure.
Because I've had a lot of people talk to me about, hey, let's make a seller finance offer on a home that's been sitting on market. So we're talking prior to this about having this as an exit strategy, it's going to be different depending on where you're at. What's the process on a granular level of creating a note? Let's say in the case where there's no liens on the home.
Sure. Okay. All right. So you own the property free and clear. We'll just use that as an example. Okay. And you want to sell it via seller financing. So it's very, very simple, very straightforward. Couple things you need to do. Particularly if you're, particularly, I'll say this, I don't speak Spanish.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Okay. So, particularly if you're looking at the Latino community, you need to have a step-by-step process already written out, highlighted. So when the home is shown, they know what that step-by-step process looks like. For us, what we basically do, we do it in both English and Spanish. Thank you for Google Translate. Uh, but we map out, okay, the first thing that they're going to do, all right, is when we show them the home, all right, we're going to ask them some general questions, okay? And we're doing kind of a pre-qualifying type of thing is what we're doing. All right, how do they make their income? You need to know how they make their income. Can it be documented? Okay. If they're an all cash business, they need to be running all that cash through the bank so it can be documented. It's got to be third party documented. That's the critical part that you need to think of. All right. Are they a business owner? All right. Do they have their ITIN number or do they have a social security number? Okay. We don't work with anybody unless they have at least an ITIN number or so that they're in the process, all right, of being a citizen or they already have their social security number. Okay. And then say we always ask, how much do you have as a down payment? I'm going to backtrack just a second. When you're marketing, when you're putting stuff out there, we market on Facebook Marketplace. When we've done our own seller finance, Facebook Marketplace, Zillow, all of that type of stuff. And we also reach out to a Latino realtor, all right, or someone a realtor who has strong connections in the Latino community, and we allow them to market it as a pocket listing. So we will say we will pay you 3%. All right, you're not getting both sides. Okay, we're paying you to go find us someone, then to bring it to us, and we give them the guidelines of what we're looking for, so they know as well. Okay. So you've got multiple people working with you, you're developing relationships with realtors to help bring those leads in. Facebook Marketplace, one of the first line that we put in there, we say seller financing available to deserving or qualified buyer with large down. That's key. Qualified seller financing or private financing. I don't say seller, excuse me. I say private. Private financing available to qualified buyer with large down. When you get those questions in, the first thing they're going to do is like, well, what's a large down? Well, the question, you answer the question with a question. All right. Well, how much do you have to put down? All right. And we will not work with anyone unless they have at least a 10%. All right. To put down. And the reason being, so if you're looking at a $150,000 home, all right, they need to bring 15,000 to the table at a minimum. Most of the time, we're looking at 20 to 20, somewhere between 20 and 25. Okay, that right there weeds out all of the tire kickers. Okay, we've all seen the no down, no credit check. All right, that's a recipe for disaster. Don't do that. Okay. You're looking for people who have large downs, who have skin in the game, and they want to live in the home. So that's how you attract them. All right. But then once you got them coming in, we do the preliminary on the phone, then we will take them through an underwriting process. We use a couple RMLOs and we reassure them that this is not a government agency. What we are essentially doing is documenting their income to make sure that they can afford the payment of the home. All right. because as soon as you hire something out, the biggest fear they are, this may be a government thing or something like that. I say, no, we're the
Yeah.
private lender. We are the lenders. Okay. But I need to verify, I don't know you. I need to verify that you can afford the payment, and I need to document that you can do that. Okay.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
And we really have had very little pushback on that once they understand. Okay. I'll give two resources. We use Call the Underwriter. .com. We use him, and then also Madison Management Services. That's another resource that you can use. They're both RMLOs, and you're going to give them the terms. All right. They're going to collect the information from the potential buyer. All right. At this point, they have put a down payment, 1,000 or 2,000 as a down payment. We've signed the purchase agreement, all of that type of stuff. That's already done. We're into the underwriting stage. A couple things that's really important that you understand on the underwriting aspect. The RMLO it's not their responsibility to determine whether it is a go or no go. You are the lender. It's your responsibility. So you need to have a pretty good idea of what you will accept and what you won't accept. In the underwriting process, there is a form that's called a 1008. That is the final summary. Make sure that you always ask your RMLO before you're going to say yay or nay that you get a copy of that 1008 form. It's a Fannie Freddie form. That's what it is. On that form, that's going to tell you what they do, how long they've been doing it, how many kids they have, what their credit score is, if they have a credit score. Credit score is not, it's just one item in many of things that we look at. Okay. So we do not base anything, because most of these people don't have a credit score, to be honest. Okay. It documents their income and how long that they've been on there, and then what their total debt to income is. That's the critical point. Dodd-Frank doesn't say anything about what the limits are as far as debt to income. Now, I will tell you from our many years of self-managing our own rental portfolio, if you've got a total debt to income of 50%, the chances that that loan's going to perform are exceedingly small. Okay. We really look at between no greater than 40 to 45%, depending upon what the situation. We prefer 40.
Now,
Okay.
in these cases, you're talking about people, that don't have credit in many cases,
Correct.
but they'll have debt. So what is that debt going to constitute? Is that going to be consumer debt? Is that going to be auto loans?
It could be. It could be any of those. It could be credit card debt. They're gonna pull that data. All right. If they've got credit cards, it's gonna pull what their monthly payment is on their credit cards. If they got a car loan, quite honestly, most of these people deal all in cash. So very few of them typically have a car loan. Okay. It's typically cash. Okay. Is how they operate. All right. So we're just looking at, what's the total debt to income ratio. Is that acceptable? Or do they look to be stable individuals? How long have they been in their job? How long have they been in the industry? Many of these people are business owners. Okay. They're independent contractors. Have they been doing this for a long time? Have we gotten the last 2 to 3 years tax returns to see? I mean, if they're a smart business owner, they're going to have a ton of write-offs. Okay. All right. So that is, it's hard for a business owner to get a loan with a bank, because if you're a smart business owner, you're going to take as many write-offs as you possibly can and show as little of income. We get that. We understand that. So
now, once you've identified, good buyer, you've gone through the RMLO, underwritten them, right? And so they've got the money to the table. They're bringing that, 10% down. At that point, you've got to create the note, right? What's
Right.
the process like of creating the note? Let's use
Okay.
Indiana as an example because I'm sure it could be
Sure.
different depending on where you're at.
All right. Wherever you're at, you need to go and talk to an attorney. Okay. And you need to get it templated. Okay. If you're looking at doing this for down the road, all right, you're going to want it to be templated for the laws of of that particular state. Okay, we have templates for Michigan, we have templates for Indiana because we've originated in both. We do most of our origination in Indiana, but it needs to be legal from the state as well as federal statutes. Now, some things that you're going to want to have in there. Okay, number one, you're going to have the interest rate. You need to make sure that there's also a default interest rate. If the interest rate's 10%, and I would typically put the default interest rate anywhere between 2 to 4 points higher than what the normal interest rate is. All right. So if
Can
you're
you
going at
explain that
10,
for myself and our audience? What's the difference
sure.
between an interest rate and a default rate?
Okay. The note rate is just a standard principal and interest, what everything is calculated on. Okay. As far as for a 30-year loan, you're going to do a mortgage calculator, and that's going to spit out what the monthly principal and interest payment is. Okay. If they default, which essentially means if they default the terms of the note, then it goes to a higher interest rate. Same thing as if credit cards, all right, you see in your credit cards, you are paying 12%. And if you have a default interest rate at 28, okay, now you can't go that high. All right, but it's the same thing. That's what it is. So
Okay.
you have a default interest rate, all right, in there. We make our loans look very close to what Fannie and Freddie does. So we have it so that the payment is due on the first. We give them a 15-day grace period. After that, there is a late fee. All right. And that late fee is 5% of what the monthly payment is, monthly principal and interest payment. Okay.
Okay.
You need to have documentation in there for we call it attorney collection clause. Your attorney will probably standard put that in standard. Essentially, it is the cost of collection, which includes if they default, and I have to send a demand letter, I can collect. All right, the attorney fees, all of the late fees, all of the cost to send the processing, filing fees, all that type of stuff. That's all collectible. Okay. So you want to make sure that that clause is in there. You also want to make sure that you want to escrow taxes and insurance. Okay. And the reason being, and this is sometimes a little more difficult to communicate in the Latino community, we require that the borrower pays 1 year's homeowner's insurance up front. Okay, so when we come to the closing table, they've already got a year's worth of coverage already in place. All right. And then we escrow taxes and insurance. That essentially means their yearly taxes and the cost of the insurance is spread out over 12 months. And that is collected with the servicing company. We place all of our loans, and we encourage every investor that we're working with that's creating these that they place the loans with a licensed servicing company.
Now, with
All
the
right.
servicing company, is this someone that the buyer would go to make their payments to, or is this something that really you're setting up the note with?
Uh, some can, but I would say you need to use your attorney to set up the note. Okay, to create the note. Once it's created, signed, then you're going to board it with a licensed servicer. And there's a whole ton of rules. All right, because now you're a debt collector. You're in the role of the bank, you're a debt collector. So you have to follow all the debt collection rules. Sorry, I do not want to follow those rules. I don't want to be, I shouldn't say that. I do want to follow them, but I don't want to be the one that's having to do all that.
Yeah, yeah.
Exactly. Okay. So we place it all with a licensed servicing company, and that fee is included in the monthly payment. So you can put that in the loan. Also, the underwriting, that's the amount of money that is charged by, say, call the underwriter to underwrite it, that it can be placed into the closing fees as well, just like a regular loan. And there can be some attorney fees or attorney prep. That's all part of the fees of the closing. So that's just like a regular loan in that respect. But ours are a lot less expensive than what the banks are. It's a lot cheaper. Okay.
Now, once you have all this, you've got the servicing set up, you've reached out to the attorney, you've got the interest rate clear, you've got the rate, the default rate, right? When they're going to pay, grace period, late fee, etc. At this point, do you have to record it with some type of body, at the county level, at the town level? How does that work?
Yes. The mortgage or the deed of trust is what is recorded. Okay. And typically we close through a title company. We encourage the people we work with to close with a title company. Some states as an attorney, but they typically will handle that for us. Okay. I've done it myself before, but I mean, they will record it. And the other important thing is that you provide both a owner's title policy and a lender's title policy. You as the seller pay for the owner's title policy. That title policy essentially protects your borrower that you are transferring deed that is free and clear, and you have insurance in place if something was missed somewhere in the last 30 or 50 years. It happens. Okay. So you're paying for that. You're protecting your borrower. The borrower or the buyer of the property is paying for the lender policy. Now that's the cheaper of the two. That protects you as the lender. And then that transfers, if you sell the loan, that transfers and goes with the loan wherever it goes.
Now, at what point in time and this is going to vary by state. In Texas, you can separate I believe it's the deed from the mortgage, right? Would the buyer take possession of title, quote unquote, when they sign these documents or when they've paid off the seller finance, the mortgage, right?
Okay, this is a note in mortgage or note in deed of trust. Okay, in Texas, it's a deed of trust state. Okay, so uh, in this type of scenario, what we're talking about, the deed is transferred at the closing, so they own the property. This is different than a contract for deed, um, land contract, depending on what parts of the parts. It's called different things in different
Sure.
parts of the country. Okay, we I'm not anti land contracts. All right. But typically, if we're going to buy that note down the road, we're going to require you to convert it over to a note and a mortgage versus a land contract. And the reason being, it's from our business standpoint, it streamlines everything. Land contracts are cumbersome to work with because now I'm in the chain of title, okay, on that property, whereas otherwise I'm just the lender.
The the three things that stick out to me in this process, of course, you want to know on a granular level everything that we just discussed, right?
Sure,
And more
sure.
more so. But if you have an attorney who understands note creation, if you have
Hmm.
a title company that is experienced and will record it properly, and then if you have a servicing company that
Hmm.
that can handle, being a debt collector, right? That
Right.
then this takes a lot of the granular knowledge out of it and allows you to focus on underwriting them, higher level activities. Is that
Exactly.
generally true, right? If you have those three
Absolutely.
people in place.
Absolutely. I will tell you, you can manage 50 notes for 5 to 6 rentals that you manage.
When we talk about what happens next, right? So
Yeah.
I've heard a number of different things now, and I've heard, okay, so you've got the note in place, you've got the buyer, and the servicing company is handling, the monthly payments. You could sell the note, you could hold the note.
Yep.
Are those the two strategies? Are there anything else that investors could do? And then also, when would it make sense to sell versus to hold?
Sure. Great question. All right. You have multiple exit strategies with the note, way more exit strategies than you do with with a rental or a house itself. Okay. With the note, particularly if you're a house buyer that's buying a number of houses every month, you're wholesaling or you're doing some fix and flips, you're selling out 5, 6, 7, 8 deals a month, something like that. One or two of these a month will go a long ways in creating massive wealth for you for down the road. It's not every deal that you have to put towards this. So that's the first thing that you need to understand. But once the note is created, it's placed with the servicing company. We like to see it seasoned 6 months. If we're working with you on a continual basis, once we get comfortable with all your systems and processes and how you're underwriting those types of things, we'll buy it a little sooner. than 6 months, you can recapitalize. Okay. If you're getting the large down payment, 15%, that is not unreasonable. Okay. That you see that. All right. On a routine basis. Say you're getting 15% down, you're getting 20, 25,000. All right. You let it season for 6 months. All right. With the servicing company, all the payments have come on time. Oh, the other thing, you might want to put them on ACH as well. So it's an automatic pull that comes out of their checking account. That makes it so much easier across the board. And everything is running as it should in that. You can sell, we encourage you to sell a partial, all right, what's called a partial, which is nothing more than a certain number of payments for a certain amount of money. The people that we work with, we talk to them about, okay, you've got funds into this. If you've done your flip right, or you're doing your house, you're wholesaling right, or you're wholesaling out or selling out to an investor or selling out to a homeowner, okay, you should be all in at 70% or less. That's been a rule for umpteen years. Okay. If you're not, your margins are in trouble. Okay. You're probably not going to survive long term. I'm being bold in that respect, but I've seen it happen over and over the years. So you should be all in at 70% or less. So when we come in and buy a partial, we are not going to spend any more money than what 70% of what the value of that asset is. And that's part of our due diligence, that we make sure that you haven't oversold the property. Some people get a little too aggressive. All right. They think because you're selling out on terms, you can ask a higher premium on the pricing of the home. And you can a little, 1 or 2 points, 3 points above, it's not that big a deal. Okay. But if you start getting over aggressive, yeah, that's an issue, because your market comps are not going to support what your pricing is. So be aware of that. You need to know what the market is. But what's going to essentially happen, all right, you're going to get a 15%, say, down payment. You're going to say the payment's $1,000 plus a month. All right. If you got that for 6 months, all right, now you've got 15,000 plus another 6 that's come in. You've got 21 grand already. Okay. We'll come in and buy a partial. Say we come in, say it's a 240 month note. Well, I'm going to just pull these numbers out of the air. I don't know if they actually work or not, but it gives you as an example. We'll come in and buy a 10-year partial. So we're buying basically half of the note. All right. But for that half of the note, all right, you are going to get, you're essentially going to get all your money back and make a little money now. That's what you're essentially doing. You've secured your sales price. You don't have to take a discount on your sales price. Whereas if you sell the entire note, you're going to sell that at a discount, because all notes are sold at a discount on the secondary market. If you think your note is so good that you don't need to do a discount, then go sell it on Wall Street, and you'll find that that's not the case. Okay. If you have notes of that quality, that will be great, but that's not typically the case.
Now, when you're
All right.
when you're referring to discount, is it a discount from the it's not a discount from the price that you paid for it? What specifically
No,
is being discounted?
it's a discount of the unpaid principal balance that's on the loan. So
I
say you
got it.
sold a house for 120,000, you got 20,000 as a down payment. So the initial note price is the initial note is for 100,000. Okay.
Right.
You season it for 6 months. All right, we're going to come in and probably, depending upon how well it's written, we're going to probably, 90, 92%. All right, so you're going to take a 7 or 8, maybe 10% discount. It all depends. If you originated it at 7%, you're going to take a much greater discount, because most investors are wanting at least a 10% return on their money. Okay.
Now, how are investors? Is there a secondary market? Are you having to send out mail? How would you go about finding
Sure.
these notes? Is it much the same way you would find like a property? Hey, kind of, whether it's calling, knocking, letters, it could be a litany of different, lead sources.
There are a lot of different ways in which you can find notes. Friends of mine, that is exactly, they look for mom and pop notes. Okay. Someone who has created a note in a mortgage. All right. They've sold a property that they owned, and they basically have done it once or twice in their entire life, and that's it. That's not our business model. We're looking to work with people who are manufacturing notes on a routine basis. Okay, where we purchased about $1.5 million last year in notes for our area here. So we're working with people who are creating notes on a regular basis. They are investors. All right. They're house buyers that buy on a routine basis. They've got the leads in, they got the marketing. We're acting as the bank on the back end to recapitalize them so they can recoup the money they've got into the deal and go do it again. That's what we're doing. Now, if you have a note and you're just wanting to sell it, there are different platforms that are out there that you can sell it on. Paper Stack, all right, paper, and then it's stac.com. That is a common site, all right, that people that it's kind of an exchange, all right, that you can post it on there. We've purchased off of there before, but we tend to want to work directly with the individuals who are doing the manufacturing and developing a relationship and working at something with them directly so that we can buy on a routine basis. So they're creating a note manufacturing business. We're recapitalizing them, buying those so they can keep doing it again. But the key thing here, I want you to realize, and for the uh, uh, real estate investor, is that when you sell a partial, you're not discounting the price. You're discounting the number of payments that you're selling, the future payments, which you don't have yet. Okay, we're taking on that risk. We'll buy, say, 80 payments for 70,000 or 100 payments for 80,000. All right. 80,000 gets you recapitalized and gives you an extra 5 or 10,000 maybe on top of what you've already made. All right. So typically those individuals have already recouped 80 to 90% of what the sales price is that they sold on it. And then after the partial has completed, all right, that note in a mortgage then is assigned back to them. And how we conduct our parcels, how we buy parcels, it's called a full collateral assignment. So you're assigning that note, you're assigning that mortgage over to us. We hold it and collect the debt for that certain period of time. Once it gets on that, say, 100th payment, then it reverts back to you. Now, a couple things is really important. There's another, say, 30, 40, 50 payments on the back end that you are going to be entitled to, and the interest that's on top of that. And you're totally out of the deal. You got no money in the deal here. Okay. You're all out. That's all gravy with extra income that's going to end up giving you about a 30, anywhere between 20 and 40% more payback than if you just sold the entire note up front. Okay. That's how you develop wealth. That's how you create long-term wealth. Yes, you have to sit and wait, but we tried very hard to get the investor totally out of the deal. If they've done what we've guided them to do, we can typically get all their money out and get them a little extra money, even as a smaller profit. They're just not quite getting it all. If the borrower pays off early, which many of these do, you've not sacrificed price. You're still entitled to everything at the back end. Wherever we are on the partial amortization schedule, that's what's entitled to us, and everything else is entitled to you on the back end. You've sacrificed nothing. The only risk that you're taking, okay, is the future potential interest on top of what's on the back end. You're not risking any money now at all. So it's a very safe play.
As you're talking, and we're getting really into all the aspects of
You wanted weeds. We're in the weeds.
That's exactly right. I feel like I now know how to do this. I've done 3 of them now in my head. I'm thinking about all the younger first time buyers who are being turned away, or
Sure.
they're frustrated with the process. And as a realtor, I wouldn't know how to go and find seller finance available homes or deals.
Uh-huh.
You mentioned Paper Stack, what would be a secondary market, and Facebook. I could look. Is there a way where, regardless of what city I'm in, I could find deals that are available seller financing?
Well, seller financing is just going to be, I would say your best place is looking at Facebook Marketplace, to be honest. That's where most of them get marketed. All right. As far as seller financing is concerned. Now, the paper stack, that is a note transaction platform.
Got
That's
it.
what that is. Okay.
Got it. So
Yeah. That's
secondary.
where notes are bought and sold.
I got it. Well, I now feel like I know every aspect of it on some level. Like I said, I've got a confidence boost, so I can now go talk with whoever I'm speaking with in the note buying space with a
There you
little bit
go.
with a little bit more background knowledge, whether it's someone who's doing single family homes or larger notes. I definitely feel like myself and all of our audience members today are appreciative of your time today here, Jay. We are coming up on time here
Sure.
though. Where can folks go to reach out to you or your team? Maybe they would like some feedback based on something they're doing, or they'd like to take a look at the deals that you have over there.
Okay, sure. There's two things that we really do here. The best place to go is just go to our website. It's Cassidy Cassidy investments.com. And you can sign up for two things. We have a bunch of free information on there to learn about notes and notes comparing to other types of investments as well. And you can sign up for our quarterly newsletter. All right, it's where we keep people who are following along with us. Some people who are private capital partners, those types of things. That's essentially we send out a quarterly letter that covers what we're doing within our businesses. And then once a month, which is typically the last Thursday of the month from 12 to 1 Eastern time, all right, we host a note talks with Kyle and Jay. Kyle's my son-in-law, all right, and we work the business together. And we spend that hour showing deals that we're working on or we're evaluating. It's a place to ask questions, seller financing. If you've got a deal that you want to get second eyes on and see what our thoughts are, um, that's the place to come. All right. And it doesn't matter what level. We've got people at all different levels that's in that group. And it's become a really nice group that everyone shares ideas, chips in. All right, what about this? It's just kind of a think tank is what it basically is for looking at notes and why this may be a good deal, why it may not. We're not going to tell you whether to buy it or not, or this is what you should do. We'll give you our thoughts and opinions and go from there and make your decisions in that respect. So, and just for signing up for the newsletter, you'll get our book, An Introduction to Note Investing. Oh, it's called Be the Bank, An Introduction to Note Investing. And that's a digital download that you can read. So that's it.
Jay, thank you so much for your time today. Thanks for coming on the show.
Thanks, Dylan. I appreciate it. Good luck, everyone. Hopefully we can buy some notes from you down the road.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.